So this morning, Mr. David, you are welcome. I see you in the house too. Good morning. Good morning, everybody. So we will be having our usual. Yesterday, I was trying to solve the question before the shutdown, and that question is what I'll quickly attempt to this morning. Make sure I complete it, then we will be able to continue from. There's this question: repayment of grant related to an asset recognized as deferred income. Repayment of grant related to an asset recognized as deferred income. So the company received a grant of 400,000 towards the cost of an asset with a cost of 1 million naira. The asset has an estimated useful life of 10 years and no residual value. The company recognized the grant as deferred income. Okay, the one we treated actually yesterday was the one where it is deducted from the asset. Fine. Okay, I'll quickly attend to that, and then I think we're trying to complete this one, and we look at the one that is treated as deferred income. Quickly that before we start today's topic, because we are going to a new standard this morning. I hope we are following as the standard is progressing. Take note of everything, because we get to a time when we also write tests in this class. That's what I do for in my physical classes. Begin to write tests, bringing icon past questions, I find out. I treated them on any topic we have treated in class. So it was on this I was working yesterday before we shut down, and I want to share the whole screen so that you'll be able to see the workings as I was doing it yesterday. So I believe you can see the Excel sheets. So that was the one we were working on, example 4. So we got to the point where we said, okay, we determine the note to the asset, we determine the value of the asset. Please, if you have any information, just use the chat box. You can't see the screen, just let me know in the chat box. And if there's any challenge at your end, noise, whatever, let me know in the chat box. So we were able to determine the value of the asset, that is, at what amount the asset will now be carried. Don't forget that this asset was, when the grant was received, what we did was to reduce the value of the asset, the cost of the asset, by the amount of the grant, leaving us with only 600,000. And we now depreciated the 600,000 over the life of the asset. So what happened was that 3 years after the asset was purchased, the company discovered an irregularity in their original application for the grant. As a result of this, the company was required to repay the grant to the government after 3 years. So we now began to account for it by saying that what happened initially, now at the time that the grant was paid back to government, this is going to be the journal. This is the journal. You debit the assets. That is, you must increase the value of the asset back, since previously what you did was to reduce the asset by removing the 400,000 from the value of the asset. Don't forget that we did an example, and this is what we did under that example. When we treated the asset, we are trying to say that the government collect the money back now. But initially, when they collected the money for the asset, this is what happened. The asset was bought for 1 million naira, and the grant was 400,000. So we took the value of the grant out of the asset. We had 600,000, and the depreciation per year was now 60,000 naira. So after that 600,000, we debited the asset and credited back, recognizing the asset for the first time. And in our financial statement extract, 60,000 naira is the depreciation per year, which we did for 10 years over the life of the asset. So what is happening is that after these 3 years, depreciation have been charged was when the reversal was made. So what we are going to be doing now, I've done it back by saying what exactly the note. I put the note here just for as a reminder of what I went to show us in the other example. So depreciation was 60,000. 3 years depreciation will give us 180,000. And so we now came to say, okay, the cost of the asset, which is the net after we deducted the grant, was 600,000. And the depreciation accumulation was 180. Therefore, the carrying amount, let me put it here, carrying amount, the carrying amount is 420. The carrying amount is 420. Carrying amount. That's the carrying amount of the asset is 420. So we are now saying when the grant was paid back to government, this is the first journal that must be passed. That is, we debit the asset back and then we credit bank because we release cash to government. And our depreciation, we now have to deal with the other part of depreciation that we did not treat previously, because it was the grant was 400,000. Let me just put it here where we arrive at 120. The grant was 400,000. 400,000. So that 400,000, if it were to be depreciated, it would be based on the life of the asset, which is 10 years. 10 years. And so the annual depreciation would have been 40,000. 40,000. And now that we have had 3 years depreciation already, we have 3 years. So annual depreciation is 40,000. The number of years of depreciation we have done so far, that depreciation, accumulated depreciation in respect of this amount, accumulated depreciation will be for 3 years. So that's 40 times 3. 40 times 3. 40 times 3. And that will give us 120. We now say what we'll be doing with the 120. That what we'll be doing with 120 is what? We are going to now be taking it to profit or loss. That is the double entry. Don't forget we are under the double entry principle here. That we are going to be taking the 120 to profit or loss. This is the first journal that we passed in respect of this asset. And now we have the second journal passed in this place in respect of depreciation. So what we are doing, so what I want to do next, I quickly do the financial statement extract and show you what it will look like at the end of year 3 after this repayment of grant was made. So the first statement I'm going to work on is a statement of profit or loss. Statement of profit or loss. Okay, let me just come in and say statement of profit or loss extract. Mr. David, well done. I saw your assignment late last night. Although I've not gone through it, but that's a very good try. Please, the rest of us, when we have assignment, let's do it to help us. So, when it will give me the assurance that you understood what we have done in class, and it will also help me to know the areas where you need assistance. The most important thing to me is to see that you are getting it. That is where I get my satisfaction from. But that's the benefit of the training. Anyway, statement of profit or loss extract. So please, if you have done your own too, as the class is going on, you can quickly drop it in the chat, or maybe immediately after the class, you can drop it in the chat. Let's know. Statement of profit or loss extract. So let me copy the Naira sign. So from year 1 to year 3 is what we are doing now. From year 1 to year 3. From year 1 to year 3. I'm just doing from year 1 to year 3. And so this is profit or loss account. As far as this transaction is concerned, what will happen is first we talk about depreciation. Depreciation. And so depreciation that we were charging previously was 60,000. Don't forget that we are coming from this example. So we have had this 3 years depreciation already when we initially collected the grant. So the 3 years depreciation will be here. We have done that already. Now, as far as the reversal of the grant is concerned, another item will come here. I will say repayment of government grant. Repayment of government grant. Repayment of government grant, and it happened in year 3. And how much was it that must come to profit or loss account? Now, don't forget what we did. We debited profit or loss here. So it's 120 that will come under year 3. 120 that will come under year 3. Sorry. Under year 3 is where we are going to be putting the repayment of government grant. It's a debit transaction. It comes here. So the statement of profit or loss for this over this in the year that this grant was repaid will look exactly like this. This is what we're going to be having there. So it is 0 here, it's 0 here, and then we have everything here. And so what I'm going to do is what just to total it, and then we have these figures. This is what we come to the statement of profit and loss in respect of the grant. This is what we are going to be having the statement of profit and loss in respect of the grant. And so we now have statement of financial position. Statement of financial position. Extract. Statement of financial position. Extract. Statement of financial position extract. And so we are going to be having the 3 years also stated to show the value of the asset as it has been. So we have year 1 to 3. Year 1 to 3. This one comes like this. So under non-current asset, non-current assets, we are going to be having the asset there. So asset, the assets figure will be here. And in year 1, after the depreciation for year 1 was charged, don't forget that at that time we're still carrying it. So we are going to be having this figure in year 1 and year 2. In year 1 and year 2, because of what we did previously, depreciating the asset using the 600,000 that we used. Okay, let me do that again. I want to close the spreadsheet. Okay, so let me do that again. So that's it. That's what we had. But in year 3 now, in year 3, the asset has gone back towards 700,000. And you can see what we did to bring it back. This is note to the transactions we are doing. Returning back the grant inside it by doing or passing the journal that says debit asset, credit bank, because we paid back government grant. And we came to the notes to the asset. The amount the asset would have been, which is 420, based on the information we had as at the year before. Which should have been what year? We are going to be adjusting it back and deducting this depreciation from it. The depreciation, you can see it, take it to the profit or loss and credit the asset. That is the journal for 120. That's why we have this. And the balance will be what? 700,000 naira. That's how to do it. If the procedure initially was that we deducted the asset we deducted the grant from the value of the asset. We deducted the grant from the value of the asset. So the other part is when we deduct the grant, when we treated the grant as a deferred income. Trying to group all these things so that it doesn't look spartan. When we treated the grant as a deferred income, let me do this one here. the next example that Mrs. Ogunle, I had yesterday you were trying to know whether grant is covered, whether the standard is covered in CHA. Yes, it may not be in the back, but it's a thing that can be tested because it's assumed that we know it already. And when I can test a thing like this for our level, they will just throw it in an exam, just throw it in an information relating to consolidated financial statement. It's important for us to have a recap of what it is. Actually, it's a topic in FR, but also by extension, treated in CR. So that is example. This example 4. When we say repayment of grant related to the cost of asset. That is, repayment of grant relating to asset deducted from the cost of the asset. That's the one we did. So quickly, I'll just do the one that has to do with deferred income. That will be example 5. Quickly, I will do that, and then we'll go to this. But I don't want to waste much time. So, example 5. And it will be what? Repayment of grants relating to asset, repayment of grants, repayment of grants relating to assets, that is related to asset and what? And then, which is this last example, recognized as deferred income. Related to asset, recognized as deferred income. Recognized as deferred income. Grant related to assets recognized as deferred income. How we treat that also in the financial statement. So, we have treated the issue of the grant, but we are talking about the repayment, how the repayment should be treated. So quickly, to remind you of what we did, I will take you to the example we did yesterday when we treated the grant as if it was a deferred income. This was what we did. It's the one we did for me. Take the second example. Yes, it's from this place we started treating it. Method 2. Yes, I should have marked it. Method 2. Maybe I should put it here. That is grant relating to assets treated as deferred income. Treated as deferred income. So this was the example. We said what you do is that when the asset is purchased, this is the journal. We are not reducing the value of the asset by the grant, and we calculate the depreciation on the asset. It stays on its own. The one that has to do with the grant, we pass the journal separately, recognizing that we receive the money, debit bank, and credit deferred income, which is liability. And we talked about the useful life of the grant is going to be 10 years based on what actually the life of the asset. That's the useful life of the grant. So because the useful life of the asset is 10 years, so the associated grant also will be 10 years. I'll say annual grant that will be recognizing as income will be 40,000. If you remember, we did that yesterday and went on to prepare a statement of financial position, statement of profit or loss extra by saying we will recognize other income 40,000 for 10 years in respect of the grant separately. Depreciation of the asset 100,000 every year in respect of the asset. So we are now talking about under this condition, the grant is repaid. How do you treat it in the financial statement? So what we're just going to be doing is that the year 1, year 2, year 3, we have this information. You see, as done before. So the adjustment will be happening only in year 3, and it's going to affect only the deferred income. Only the deferred income in year 3. So let me quickly, I just went there to let us be reminded. So previously, this was what we had in the financial statement. So I'll do statement of, okay, now in year 3, let me do the double entry for the reversal, double entry double entry for this reversal. So we have debit and then we have credit. We have debit, we have credit. So the first thing we are going to be doing in year 3, that's okay, let me just put year 3 here. Year 3, which is when the grant was prepaid. The first thing we are going to be doing is to know how much remains in our deferred income liability account. How much remains? Don't forget I said the deferred income will be allocated every year, just the same way we allocate depreciation. And we're allocating it 40,000 year 1, 40,000 year 2, 40,000 year 3. So those are the ones we have allocated into our income in respect of the grant. Now that we want to pay back the grant in year 3, this one that we have done in year 1 and year 2 is gone. We can't be reversing it. But what we are going to be doing is to know how much is the balance in the deferred income account as at year 3. How much is the balance, which is what? 240. The opening balance for year 3 is 280. Okay, we're working with the opening balance. Don't forget we did this yesterday. I hope you still remember what we did here, saying that the deferred income in the first year is going to be what? Current liability, which is the one meant for the next year, and the non-current liability, which is the one beyond 1 year. So when we allocated this to profit and loss in year 1, what remains is 360. 40,000 out of the 360,000 will be a current liability, and the remaining 320 will be non-current liability, because 40,000 is the one we are supposed to recognize in year 2. A liability that is recoverable or dischargeable in a year's time is a current liability. So anytime you have liabilities that has both current and non-current elements, please be sensitive enough to separate them in your financial statement. If, for instance, a company obtains a loan and you're supposed to be paying the loan every year, and now at the end of year 1, the loan remains 400,000. You have 4 more years remaining to pay the loan. But in a year's time, you'll be paying 100,000 naira from the loan, and the 300,000 naira will be from the year after the next year. Please, when you get your financial statement, separate it. That one that is payable in 1 year time, take it to the current liability. The one that is payable beyond 1 year time, take it to the non-current liability. So, opening balance of our deferred income as at the end of year 2 and as at the beginning of year 3 is what? Is 280,000. That's the opening balance. We have used only how many years for the sorry, it's 320,000, I should say, because we have separated them to what? Current and non-current. So it's 320. So we have been able to allocate 2 years income, year 1, year 2, from 400,000, and we have a balance of 320,000. So what we are going to be doing, the first journal is what? To debit that amount outstanding. We are going to be debiting deferred income with 320,000 and crediting our, first we debit, deferred income by reversing this money, 320,000, and then we are going to credit bank because the money is going out of bank. But this amount of 80,000 remaining must also be withdrawn because we have allocated the 80,000 in the past. So we can just pass the whole journal for the reversal of the deferred income. So it will be what? We debit deferred income, with how much? With the amount remaining inside, which is what? 320,000. Then we debit our profit or loss account. Profit or loss. With how much? With how much we have credited into it before, which was what? 80,000. That is 40,000 for year 1 and 40,000 for year 2. And the third leg would what? We credit bank, which is what? The repayment of the grant, 400,000. So, and what? Okay, let me put the Naira sign and the rounding so that we are not having error in our. Okay, let me just drop it and then create a space for it. So we have this one here. We have it here. So that is journal, and the description of the word being the repayment of grant. So you remember what we did? The balance remaining in deferred income. Okay, I should say deferred income. Income must be taken out. I want to be sure that we understand the implication of a journal that debits a liability account and the implication of a journal that debits an asset account. These are things that we should not forget from our normal FA transaction. Liabilities should have credit balance. So when you want to reverse it, the journal is to debit it. Asset normally has debit balances. So when an asset impairs, you credit asset. When asset increases, you debit asset. I hope you understand. So deferred income is a liability account. So it has a credit balance of 320 as at the end of year 2, and which is the same thing as at the beginning of year 3. End of year 2, and it's also the opening balance for year 3. And I'm sure you know, closing balance for 1 year is the opening balance for the following year. So as at the end of that year 3, that year 2, we had 320,000. 320,000 for deferred income. So first is that we debit it to write off that account. When we debit it, deferred income becomes empty. The ones we have put in profit or loss previously, we debit profit or loss with it too, and so we credit back to ensure that we have repaid the grant. So the financial statement extract now quickly, statement of financial position. Statement of profit or loss first. Profit or loss extract. Statement of profit or loss extract. We are just going to be having the 3 years. We are going to be having the 3 years. We are going to be having 3 years. That is year 1, year 2, year 3. Year 1, year 2, and then year 3. So what we have to do is what? Other income. Other income, which we recognize only in year 1 and year 2. Other income. Don't forget what we did that time. Other income was what? Let me take you to where we treated it. Other income in year 1 and year 2. Other income in year 1 and year 2. Other income relating to grant is what? 40,000. You cannot go back to those years and be changing the figure again. Even though we paid the grant in the 3rd year, this our financial statement will still have this kind of loop. Sorry. It will have this kind of loop. So other income in year 3 is what? 0, because we are no longer recognizing other income. However, we are going to be having a figure taken to profit or loss, which is the amount of debit we take to it. It's an expense. So the payment of grant in year 3 would be what? 80,000, which is a reversal of the 40,000 we have put in already. And depreciation will not change, because just like we had it, we did not deduct this grant from the asset. So we were having it. I'm just trying to show you what we did previously. Depreciation was 100,000. It will still be 100,000 over the 3 years. I'm showing you what the financial statement will look like. That is the face of our financial statement. What it will look like is what I'm trying to show us, and that's it. That's what we are going to be having in respect of this asset, in respect of this transaction, that is reversal of the grant we recognized previously. So we now have statement of financial position. Statement of financial position. Extract. That one, the deferred income we were trying to recognize previously, is what we are taking out. Let me just show us again. only 3 years. We are presenting it for 3 years because this is an event that occurred just in 3 years, reversal of the grant. So our assets, non-current assets, non-current assets, we'll be having the balances it had when we treated it initially. How much was it? These are our non-current assets. So because of annual depreciation of 100,000, this is what will remain there. I'm trying to copy there to connect you with what we did previously so that we don't take time, we don't waste time trying to start the training all over again. And the second thing we are going to be doing is to go to our what? Current liabilities, current liabilities, current liabilities, and we have deferred income, deferred income, deferred income and current liability. And so what do we have in our deferred income? We had in year one, it was 40,000. Let me show you again so that you know exactly where I'm picking my information from. You can see in year one, we had our 40,000 for year two. It will not change because we have treated this already. We are showing what the financial statement will look like when the grant is reversed. It will not change. So, but here, there is nothing like current liability again because everything changed in year three. And so, non-current liability again, non-current liability. Non-current liabilities, and we also have deferred income, and at the end of year one, you see what we had here, because you know they were treating it as if it was their own before they eventually had it. You know, this is what we're going to be having there. Just this, we're going to be having it in our financial statement regarding non-current liability. But that was the situation. We were still believing that the grant we owe, and eventually we come to this place and say what? It become zero. Nothing will remain because we have paid by the grant. We have paid by the grant. So the only thing that we can just do here again, let me just add it so that we'll be able to see on the face of financial statement what has happened. Our current liability, our current asset, current asset, our bank account is the one that will now be bearing the brunt of the payment of 400,000 in year three. So we just put the negative 400,000 there. Put the negative 400,000 there so that we know what has actually happened, that we repaid this money back. This 80,000 that we took to this place and this 320,000 that we took to this place, which is this amount, yes, which is what was here, will now eventually be this 320. Yes, this 320, the addition of this and this, which was 320, will give us 400,000. 80,000 plus 320, the repayment of grant, is why we put our bank in negative. That is the financial statement extract in respect of this transaction. Financial statement extract in respect of this transaction. That's how grant should be treated. It is the profit or loss account that will bear the burden when you repay. You cannot go back to the years when you were still hoping that the money is yours and be changing the figures. No, you'll be treating it as though you were using the grant, utilizing it, but in the year when the change happens, everything must change. Year three. So that's all about that. If you have questions, you can put it in the chat box. I will look at it and attend to it later. And without much ado, let's go to today's topic so that we achieve what we are supposed to achieve today. So today, we'll be starting a new standard, IFRS 15, revenue from contract with customers. IFRS 15, revenue from contract with customers. This standard was actually brought about to resolve all the challenges that has always been regarding revenue recognition. Okay, let me just take 1 minute of your time I was on Gen, they brought live. Just switch over. In 1 minute, I'll be back. Just hold on, please. So thank you for your patience. So I'm back. So revenue from contract with customers. Revenue from contract with customers. So the concept of this standard is to provide a universal standard that will help the preparers of financial statements to have uniformity in the recognition of revenue. The figure that will appear on revenue in the financial statement is to be determined using this standard. It is the measurement prescribed by this standard that determines how much we recognize as revenue. So the standard encapsulates the principles of revenue recognition and some transactions that fall under this standard. So we'll be laying the foundation of this standard today, and we'll be completing it next week. That's most of the computations we done next week. Today we just need to lay the foundation so we have a background insight into what the standard is all about and why the standard was actually introduced. So revenue from contract with customer. First, we define what revenue is. Revenue is income arising in the course of an entity's ordinary activities. That is, if you are into laundry services, you wash people's clothes. That is your ordinary activities. The income that comes from there is what you recognize as revenue. Your uncle comes to greet you and gives you 200,000. That is not revenue. Or another money comes to you that is not relating to the business you do. That is not revenue. That would be a gift treated separately somewhere in a financial statement. So a customer is a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities. You can see we are emphasizing ordinary activities, ordinary activities, ordinary activities. So for somebody who is into laundry services, someone who brought clothes to you for you to wash is your customer. The ones who patronize you, that is, patronize the business you do, are your customers. So we are looking at the core principle and the 5-step model. There are principles that that transactions must comply with before such transaction. I'm sorry, back. So there are some principles that must be complied with before transactions are treated as revenue under the category of Ifrs 15. So core principles and 5-step model. A contract to supply goods and services places a performance obligation or a number of performance obligations on the seller to deliver goods and services in accordance with the contract. Goods and services being sold are often described as deliverables. Goods and services that you sell in the ordinary course of business are referred to as deliverables. So what do we mean by a core principle? IFRS 15 is based on a core principle that requires an entity to recognize revenue, one, in a manner that depicts the transfer of goods or services to customers. Two, at an amount that reflects the consideration that the entity expects to be entitled to in exchange for those goods and services. So this standard, it says You're recording an amount under revenue. It must be in a manner that depicts how the services and the goods are delivered to customer, and at an amount that reflects the consideration the entity expects, the amount you are expecting to receive. That's the first principle. Then we have the five-step model. The five-step model. Applying this core principle involves following a five-step model as follows. Step one, the first step is identify the contracts with the customer. So if you want to treat an item as revenue, first under IFRS 15, you need to identify the contract. It must be explicit. Two, identify the separate performance obligation. That is the things you must do as an entity under that contract. The things you must do as an entity under that contract, you must identify it. Three, determine the transaction price. At how much are you going to be performing this obligation? Then four, allocate the transaction price to the performance obligations. That is, if you have different performance obligations, each of them must carry price. And the fifth one says recognize revenue when or as an entity satisfies performance obligation. As you satisfy obligation, when obligation is not satisfied, revenue is not recognized. It's only when you have satisfied the obligations that you can recognize revenue. So when you receive money in advance for a service or goods you have not actually, service you have not rendered, or goods you have not transferred to the customer, that is not to be recognized as revenue. It will be recognized as deferred income. It's a liability. It's after you have performed your obligations that that money becomes your own. And that is when it becomes revenue. So we are going by looking at an example of the summary of these guidance. We look at a scenario that will actually explain what the five-step model talks about. It's a summary of guidance. X Limited is a software developer. Now you can see X Limited enters into a contract with a customer to transfer a software license, perform an installation service, and provide unspecified software updates and technical support for a 2-year period. That is the contract that they entered into. So the first thing, IFRS 15 provides guidance in the following areas. Step one, whether the contract is within the scope of IFRS 15 and what to do if IFRS 15 does not apply. Step two, if IFRS 15 applies, whether the contract contains a single performance obligation or separate performance obligation. You can see license is there, installation is there, software update is there. So these are performance obligations. So it may be, we are seeing them separately, but it may be contained in the contract as a single performance obligation. We'll be seeing the conditions that will make us treat them like that. So step three, how to identify the transaction price and whether this should be adjusted for time value of money. This by next week, we'll be looking into this computation of time value of money. That's when we'll be doing the actual computation of how to determine the amount of revenue because of the scope of the syllabus. So, time value of money, what to do if the consideration might vary depending on circumstances. Step four, how the transaction price should be allocated to the separate performance obligation. These are the guidance inside IFRS 15. And finally, we say whether the performance obligation is satisfied, and thus, okay, we are in class. Okay, Ineka is trying to talk to me, doesn't know we are in class, so we'll do that later, please. So, whether the performance obligation is satisfied and thus revenue recognized over time or at a point in time. So, we want to look at the five-step model and see how it is applicable. And now we should deal with it in the examination when we are confronted with questions on this standard. Okay, I think someone's saying something. All right. Okay. So we move on. Step one. Step one. Step one. Step one. Step one. Identify the contract with customer. That's the first step. Don't forget, I listed the step in about okay, 2 slides away. You can see identify the contract with customer. That's step 1. So how do we do that? A contract is clearly defined. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. So if 2 or more persons come together, have an agreement, and that agreement can lead to right to enforce obligation and enforce rights, then it's a contract. 2 of us, you hire a vehicle, a charter vehicle to take you from your base to another place. The driver man charges you how much he's going to collect. You agree on paying the money, and he also agrees on taking you to where you are going. That's an agreement. Then to test whether it's an enforceable right, if the driver stops on the road and said he's not going again, can you force him to refund your money, or can you put him under certain obligations that may not be convenient for him just because he has made things not convenient for you to? 2, if the driver takes you to where you are going and it's now time to pay and you refuse to pay, can the driver force the money out of you? If you can answer yes to these questions, then it's a contract. Please note that when we cannot answer yes to these 2 questions, it is not a contract. Somebody agrees to do something for you. You have agreed to pay the person. The person decides not to do that thing, and there is nothing you can do about it. That is not a contract. But if the person decides not to do that thing and you have fulfilled your part, your obligation, or your part of the deal, you have fulfilled it, and the person decides not to do his own part, and you cannot do anything about it, that is not a contract. It can be described as something else. So please, the 2 parties must have the rights and obligations. Combination of contracts. 2 or more contracts entered into at or near the same time with the same customer or related party must be combined and treated as a single contract if one or more of the following conditions are present. You can combine contracts. That is, carry me to this place, carry me to this place, do this for me. You can have 3 or 4 contracts combined, but these are the conditions that can allow for combination of contracts. 1, the contracts are negotiated as a package with a single commercial objective. That is, all these different things, like this issue of software that we talked about earlier, that is, you want to get me software license, you want to install it, you want to provide updates. If we negotiate these 3 contracts together and then agree on an amount, one amount, then we can say it's a contract that must be combined. 2, the amount of consideration to be paid in one contract depends on the price or performance of the other contract. That is, if I will pay you for installation, it must be that you are the same person that will provide the update. When there is a condition of that attaches another contract with one contract, then the two contracts have become one, and they must be treated as a single contract. 3, the goods or services promised in the contract, or some goods or services promised in the contract, are a single performance obligation. That is, you have to do, it is one thing you will do that will satisfy the rest. That is what we refer to as contracts that can be combined. When these 3 things are not in place, the contract can be treated separately, and so we'll be able to treat them separately. So application criteria, the criteria for applying it. The general IFRS 15 model applies only when or if, that is, you apply this standard on this condition we want to listen to. IFRS 15 is applicable because I can just come and just put question and say we should tell the conditions that must be satisfied before a transaction qualifies to be treated under IFRS 15. These are the criteria. 1, the parties have approved the contract and are committed to perform their respective obligations. The 2 of them have agreed and they have commitment to perform their obligations. Two, the entity can identify each party's right, that is, the organization, that is you, the company that wants to treat this as revenue. You must know your right, and you must know the right of the other party. Three, the entity can identify the payment terms for the goods and services to be transferred. You know the terms of the payment that has been agreed before time. Four, the contract has commercial substance. To say it has commercial substance, it means what? It is expected to change the risk, timing, or amount of an entity's future cash flow. Don't forget when we were treating IS 16, those of us in class, and we say you give up one asset for another asset. It might have commercial substance, it might lack commercial substance. When we say something has commercial substance, it means that transaction can have effect on your cash flow in the future. But if it will not change your cash flow in any way, it is not a substance, it does not have commercial substance. Finally, it is probable the entity will collect the consideration. You are certain that you will collect this money. That is the only reason why you can treat the transaction under IFRS 15. You are certain that this money we are talking about will come to you. You are certain that this money we are talking about will come to you. That is the condition under which you treat this contract. Coming, let me just do some things open up and avoid it interrupting the screen. So it is probable that the entity will collect the consideration. Next, we now have example. They are on the application criteria. Examples on application criteria. We say X Limited is a real estate developer. We want to know whether this transaction can be treated under IFRS 15. That's what we are trying to do. X Limited is a real estate developer. X Limited enters into a contract with Mr. A for the sale of a building for 1 million naira. Mr. A intends to open a restaurant in that building. You can see that's the contract. You want to sell a building for 1 million naira, and this man that wants to buy the building wants to run a restaurant in it. The building is located in an area where new restaurants face high levels of competition, and Mr. A has little experience in the restaurant industry. Mr. A pays a non-refundable deposit of 50,000 naira and enters into a long-term financing agreement for the remaining 95%, which he will pay out of the proceeds of the restaurant. You can see the condition attached to the payment of this price of consideration is that this man will run the business successfully. So X Limited can repossess the building if Mr. A defaults, but cannot seek further compensation. That is the condition in the agreement. That is, I'm selling this building to you. You want to run your business in it. You deposit 50,000. You pay the remaining, because it's 1 million. So the remaining 95%, you pay it over time as you begin to sell. That's the agreement we have. And now, if you fail to pay, I'll collect my building from you, although I cannot force you to make further payment. But the problem with this payment transaction is that the location where this building is, there are a lot of restaurants there, and there is high risk of they have high level of competition because a lot of people are running restaurants there. And Mr. A that wants to come and run this restaurant has no experience in restaurant industry. And the condition for which this the company selling the building, the condition for them to recover their money is when Mr. A makes sales. So we are now trying to answer the question based on the application criteria. The first question, the parties have approved the contract and are committed to perform their respective obligation. Yes, they have approved the contract. The two of them have agreed. Criteria 1 met. Criteria 2, criterion 2. The entity can identify each party's right. Yes, Mr. A will pay 50,000 now and will be paying consistently over a period of time as he makes sales. So the right to receive consideration from the company selling the building is clear. Also, the right of the company to withdraw the building if Mr. A defaults is there. The right of Mr. A to use the building to run his business is there. So the answer to that is also what? Yes. So criterion 2 also met. Criterion 3, we go on to it. The entity can identify the payment terms for the goods and services to be transferred. Yes, the two of them identify the payment term. What is the payment term? Deposit 50,000 naira, pay the remaining 95% over a period of time as you make sales. That's the payment term. So criterion 3 also what? Met. Criteria 4, the contract has commercial substance. Yes, because money will come from this transaction to the entity selling the building. Of course, there is future cash flow that will be changed as a result of this transaction. So the fourth thing is what? Is it probable the entity will collect the consideration? That's where we have a problem. Because the condition upon which this money is recoverable is that Mr. A will make sales and pay. But look at the conditions, the risk Mr. A is facing. He has no experience in running this business and he wants to come and compete with people who are advanced in this, and there are a lot of competition around. So it is not probable. That's the only no we have in this criteria. It is not probable that this company selling the building will collect their money. It's not probable. You can't be sure because the condition that Mr. A has no experience, is inexperienced in a restaurant, and the competition around the place makes it a difficult thing for us to be sure that he's going to pay. Therefore, since we cannot answer yes to all these criteria here, since we cannot answer yes to all of them, then the contract does not qualify to be treated under IFRS 15. It is not to be treated under IFRS 15. We cannot recognize revenue until something happens. What is it that happens? Until he pays or we are able to recover our building. So this 50,000 naira that the company has collected from Mr. A will be treated as a deferred income, a liability in the financial statement of Mr. A. Sorry, not Mr. A, of the company, because we're talking about X Limited now. The X Limited, the asset developer, we are looking at that company and how they will treat this transaction in their financial statement. Mr. A is a customer, X Limited is the entity that we're talking about. So in the financial statement of X Limited, once they receive this money, they will debit bank and credit deferred income. They will leave that balances in that account like that until they will now see, okay, oh, Mr. A has defaulted, he cannot pay, they recover the building. It is the date they recover the building that the contract becomes terminated, that they will now go and move the 50,000 naira to revenue. And what's going to be the journal? Debit deferred income, credit revenue. Debit deferred income. Let me show us the journal here. IFRS 15. IFRS 15. So, example 1. Example 1. So we talk about X Limited, the company that makes the contract. X Limited. So we want to look at journals here. Let me put the journals here. Journals. So debit, credit. So let's get the Naira sign somewhere there. Debit, credit. Remove the rounding. In this case, not necessary. Put it here. So now, the first journal, when the money comes in, is what? Debit bank. With how much? 50,000. And credit deferred income. With how much? 50,000. And that is going to be what? Being the being the liability recognized recognized in respect of the sale of building. That's the description for that journal. That's the description for that journal. That's the recognition. That's what happens at first. Because you can see we are not taking anything to revenue because we have seen that the criteria. Oh, I'm sorry. Can you see the? Yeah, I know you can't see the exercise. Let me quickly show it to you. You know, I was trying to minimize the screen because of the. Okay, let me quickly let you see what I was doing. Can't see the exercise. Yes, please. I'm not seeing the exercise. Yes, I know you can't see the exercise. So that's the journal. That's the journal. Debit bank, debit credit, debit bank, when the money was received, and credit deferred income. We will leave this account like this. We will leave it like this until if by chance, so Mr. A is now lucky. If he is paying, as he is paying, this will be the journal. Let's say in year one, he pays 30,000 with debit bank, credit liability. The liability will be increasing, the bank will be increasing because we have collected money. We cannot recognize revenue until after he has finished paying because the criteria are not met. The criteria, the 5 criteria, these criteria we're talking about, the 5 of them are not met at inception. It is not probable because of those challenges. It is not probable for us to collect this money because what? Mr. A lacks, he has little experience in restaurant industry, and the location of the business is even in a place that there is high level of competition. We cannot take anything to revenue. But when the contract terminates, now this is general. So let's assume he didn't pay, and eventually the S Limited recovers the building. The journal would be, let me copy the check. He didn't pay, the company recovers the building back. The journal will do what? Debit deferred income. Deferred income. With how much? The amount we credited to it previously, and then we will now credit revenue. It now becomes what we can recognize as revenue at the end of the contract. We move the money to revenue account. Being revenue from revenue from contract with Mr. A. That's it. That will be the journal. At the end of the time when eventually the contract terminates, and if he has been paying and we have been accumulating everything he pays in the liability account, at the end of the period, we will move everything he has paid to the liability account. So that's the journal in respect of that. So because those 5 criteria were not met, this is going to be the condition for treating the transaction. It does not qualify to be treated as revenue until it eventually terminates. So let's move on. So step two. Identify the separate performance obligation. Don't forget the 5-step model, you will treat them one by one. You can see. Step 2, identify the separate performance obligation. Identify the separate performance obligation. A performance obligation is a promise in a contract with a customer to transfer to the customer either a good or service or a bundle of goods or services that is distinct or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to customer. That's what we call performance. When you hear performance obligation, for instance, now, okay, you people and I are in a contract now. I'll be rendering ICANN courses tutorial, and you are under the obligation to pay. When you pay, you have the right to enjoy the service. And I also have the right to enforce payment. We can even be using this one as an example so that we understand what we're talking. So the performance obligation on your part is that you pay. Performance obligation on my part is that I render this service and I make sure you enjoy it. So we are in a contract. So the rendering of service is the performance obligation on my part. The payment of the consideration is the performance obligation on your part. That is what we are looking at under step 2. Identify the separate performance. So under this our relationship now, which is a contract, we can understand that we can now see our performance obligation. We need to identify it. So we talk about distinct goods and services. At the inception of a contract, the entity must assess the goods or services promised in a contract and identify as performance obligation each promise to transfer to the customer either a good or service or a bundle of goods or service that is distinct, or series of distinct goods or services that are substantially the same and that have the same pattern of transfer to customer. So I want to talk about distinct goods. What we are looking at in distinct goods is okay, let's look at this training now. For instance, somebody wants to register for ICANN, somebody wants to pay for ICANN examination, you want to attend a tutorial, you still need to get some ICANN parts or some textbooks. Let's assume that those are the things that one person needs. Those things will be treated as distinct goods, except by the policy of this entity, this light up run this service. If by our policy, once you sign up, it covers materials, it covers tutorial, it covers mentorship, it covers examination registration. When that is the policy we have, and you negotiate all these things together as one transaction, then they are going to be treated as distinct. That's why we say a goods or service or a bundle of goods or services. But if by policy we do registration separately, we sell materials separately, we render tutorial separately, if this is what I was trying to avoid, if these are the things we do and you want to come, then on agreement from the one that you are joining the service, we'll let you know. Materials, you want to buy this material, this is how much. You want to attend tutorial, this is how much. You want us to help you with examination registration, this is how much. We list all those things that we do and their prices. So that's what we mean by a series of distinct goods or services that are substantially the same and have the same pattern of transfer to customer, described by reference to promises satisfied over time. We'll be learning about that over time and some time in the at a point in time. That's what we mean by. So 2 is to identify what is the separate performance obligation. That's one step to know. So we say a goods or service is distinct if both of the following criteria are met. 1, the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. And 2, the entities promise to transfer the goods or services separately identifiable from other promises in the customer. That's why we treat them as distinct goods, separately treated as distinct goods or services. Separately treated as distinct goods or services. So we say if a promised goods or service is not distinct, it must be combined with other promised goods or services until a bundle of goods or services that is distinct can be identifiable. That's if you can't separate it, you combine it until it's able to separate. Until you're able to separate. This could mean that all the goods or services promised in a contract might be accounted for as a single performance obligation. If you can't separate it, then it's treated as one contract. Next, we have an example. Distinct goods or services. X Limited is a contractor which enters into a contract to build a hospital for a customer. We want to build a hospital for a customer. X Limited is responsible for the overall management of the project. and identifies various goods or services to be provided, including engineering, site clearance, foundation, construction of the structure, installation of equipment, and finishing. The question is, are these goods and services capable of being distinct? Let's see the analysis here. Analysis, the first question we are going to ask is, can the customer benefit from the goods or services either on their own or together with other readily available resources? The answer is yes. Why? X Limited or its competitors regularly sells many of these goods or services separately to other customers. Also, the customer could generate economic benefit from the individual goods and services by using, consuming, selling, or holding those goods or services. For the second criteria, is X Limited's promise to transfer individual goods or services in the contract as separately identifiable from other promises in the contract? The answer is no, because look at it. How can you separate building a clearing of site? You are a contractor, and they have given you contract to do what? You will do engineering, which is supposed to be part of what you do. You will do site clearance. Who is supposed to be doing that? It's part of the job. You have collected it. You build foundation. Can you separate this? You construct construction of the structure. Can you separate this? Installation of equipment and finishing. You have signed up for all this together. And so the answer is no. X Limited provides a significant service of integrating the goods and services, the inputs into the hospital, the combined output for which the customer has contracted. So it is a wholesome contract. You can see X Limited is responsible for overall management. That is what they signed. Therefore, this is one contract combined. So the amount that will be treated, the contract will not be treated as separate performance. The performance obligation will be treated as one, which means if you default in one, it might affect the your consideration that you are expecting to receive. Another example, listed goods or services. X Limited is a software developer. X Limited enters into a contract with a customer to transfer a software license, one, perform an installation service, two, and provide unspecified software updates and technical support for a 2-year period. You can see, you will provide license, you will install, and you want to do updates. Now, you say X Limited sells the license. You can see the condition is there by nature of X Limited's business. Sells the license, installation service, and technical support separately by policy. They don't do it together. Unlike the example we had earlier, which is the company is responsible for overall management. It's different from this one. They, by nature of the business of X Limited, it treats them what? Separately. The installation service is routinely performed by other entities and does not significantly modify the software. That is, the installation service, maybe X Limited will contract it to another company, and whether they install, whether they update or they not update, it does not change the face of the software. Are the promised goods and services capable of being exchanged? Look at analysis. First one, can the customer benefit from the goods and services either on their own or together with other readily available resources? Yes, the customer can benefit from it. The customer can benefit from each of the goods or services either on their own or together with the other goods and services that are readily available. Two, is X Limited promise to transfer individual goods or services in the contract separately identifiable from other promises in the contract? The answer is yes, because by nature of X Limited, it performs them separately. So it must be separately identifiable. So the answer is yes. And what? The installation service does not significantly modify or customize the software. So the software and the installation service are separate outputs instead of inputs used to produce a combined output. You can see they are separately recognized. So the conclusion is what? X Limited should account for four separate performance obligations: the software license, the installation service, software updates, and technical support must be separated. Why we are laying this foundation is so that when we are face to face with computation, we will know where the principles are coming from. Of course, when it gets to computation, I will also be referring you to this so that we can be able to know exactly the principles behind how much will be recognized as revenue. That's the goal of this standard. Revenue must be recognized in a period. How much should be recognized as revenue? And what are the principles for determining what the revenue will be? When ICANN want to test IFRS 15, they know how to present it. So I go to the next slide. Step 3, determine the transaction price. This is where some computations are coming in. The transaction price is the amount of consideration an entity expects to be entitled to. Just a moment. That an entity expects to be entitled to. Okay, trying to check how many people are here. Expects to be entitled to in exchange for the goods or services promised under a contract, excluding any amounts collected on behalf of third party, which is VAT, of course, sales taxes. You don't recognize VAT together with revenue. I know some of us are accountants, and we do these transactions at work. I have seen cases because I worked in a firm for 2 years. And I've seen cases where they make these mistakes a lot. You sell an item inclusive of VAT. You throw all the money in revenue. No, you need to separate it. And the double entry will be debit receivable if money has not come, credit revenue with the amount that should be going to revenue, and credit VAT remittable with the amount that must be going to the VAT. Don't worry, when we get to that brief, we'll cross it. When we begin to do the separation of what's not supposed to be part of the transaction price. So transaction price is adjusted if the entity, e.g., based on its customary business practice, has created a valid expectation that it will enforce its right for only a portion of the contract price. That is, you can only adjust it if there has been an agreement that has created a valid expectation that it will enforce its right for only a portion. That's the only way you can adjust. Otherwise, no, you recognize the price completely. The nature, timing, and amount of consideration promised by a customer affect the estimate of the transaction price. An entity must consider the effect of other factors when determining transaction price, including the variable consideration, that's including constraining estimates of variable consideration. Is the consideration that can come in determined on some circumstances and the time value of money. That's what I said we'll be knowing more about the time, the computation when we get to that place. So step 4 is allocate the transaction price to the performance obligation. Allocate the transaction price. So the transaction price is allocated to each performance obligation in proportion to those standalone selling prices determined at the inception of the contract. A standalone selling price is the price at which an entity would sell a promised goods or service separately to a customer. That's what we call a standalone selling price, an amount that you will sell the price separately. I will be treating the example shortly to see how that is done. Allocation of a discount. When the sum of the standalone selling prices of goods or services promised in a contract exceeds the promised consideration, the customer is receiving a discount. The discount should be allocated entirely to one or more, but not all performance obligations in the contract if all of the following criteria are met. The criteria for allocating discount: each good, service, or each bundle of distinct goods or services in the contract is sold regularly on a standalone price. That is, the goods you are transferring have their own standalone prices. 2, a bundle or bundles of some of those distinct goods or services are sold regularly at a discount if you sell the good as a discount on their own. So the discount to the standalone selling price of the goods or services in each bundle. That is, you give discount naturally on that particular goods. You calculate discount on it. Finally, such discounts are substantially the same as a discount in the contract. That is, the discount you give naturally is because when we're talking about discount, you are one company that want to do 5 things for one customer. It is not impossible that if, for instance, those five things, one is 80,000, one is 100,000, one is 70,000, one is this. When you aggregate it, let's say the money amounts to like 330 or 310,000, and the customer comes to negotiate that since you are the one doing everything for me, I'm paying you 300,000 for everything. That's where this allocation is coming from. Now, 10,000 naira has been given as a discount, and you need to recognize revenue in respect of these separate goods in the financial statement, especially when they are not from the same department in a company. You need to know how to allocate this discount to each of those goods, and that's the computation we'll be doing now. Example, allocation of discount. X Limited sells 3 products at the following standalone selling prices. So product A, B, C. Standalone selling price is 40 naira, 55 naira, 45 naira. That's how much they sell each of these products. X Limited sells one each of the product to YPLC for 100 naira in total. That is, all these items together, X Limited eventually is going to receive 100 naira in total. Conditions: product B and C are sold regularly together for 60 naira. Look at this condition we mentioned here. That is, a bundle or bundles of some goods of those distinct goods are sold regularly at a discount to the standalone selling prices of the goods or services in each bundle. That is, by the nature, we're not saying by the nature of the operation of X Limited's business, product B and C are always sold at a discount. When they sell them together, they sell them for 60 naira. The products are to be delivered at 3 different points. Now, that's where the issue is. So they are not going at the same time. A will go separately, B will go separately, and C will go separately. The delivery of each product is a separate performance obligation. That's another thing that makes it. So the delivery of product A does not depend on the delivery of product B, or product C does not depend on the delivery of product A. They are separate performance obligations that must be that must have their own revenue recognition separately, because they may happen at different times. So what we have to do now is to allocate the transaction price. We want to allocate the transaction price, and that's what I'll be working out for us in Excel now. Example 2. Example 2. Okay. Example 2. So what are we doing under example 2? We are allocating discount. Allocation of discount. Allocation. Discount. So allocation of discount. The information we have is that there are 3 products: product A, product B, product C. So those products have standalone prices. So let me put products here. Products. Products. Standalone selling prices. Standalone selling prices. And then we are going to be looking at the discount. So then we have consideration received. Consideration received. So let me wrap the text so that everything will fall into place. standalone selling prices, products, the discounts, the consideration received. Consideration received. Okay, that one received. So we have product A, B, C. So I'll put the Naira sign here. Naira sign. So product A, product B, product C. Product C. So standalone selling prices based on the information we have in the question is what? 40, 55, 45. This one is 40, this 55, this 45. So we want to see how we allocate discount. Now, this question tells us, the question tells us, let me be sure I'm sharing. Okay, sorry. Wanted to be sure I'm sharing the whole screen. Sorry for that. I know you would have put it in the chat that the screen is not. I tried to minimize it previously. I hope you can see the Excel now. Sorry. I was changing the function because some messages were trying to interrupt the class. That's why I was changing the function. So this is what I was doing. Example 2. I'm looking at allocation of discount. I will just put the headings there, the products, standalone selling prices, the discounts, the consideration received, and these ones are in Naira. So these are the products. These are the products, and this is the standalone selling prices that the company sells the products by their policy. So the question says that products B and C are usually sold for 60 Naira together. So what it means is that it's only the two of them that will bear the brunt of the discount. Because by nature, when you sell them together, you sell them at a discount. The two of them are supposed to be 100 Naira. So you sell them for 60 Naira. So, and eventually what the customer paid was 100 Naira. What the customer paid was 100 Naira. The customer should have paid 140, but we gave a discount. So what it means is that there will be zero discount here. And so we are going to be having this here. Okay, I'm coming. This plus 0. We are going to be having this here because those ones that are sold at a discount are the ones that we treated as the one with discount. Since they are by nature sold at a discount, then for here, how then do we allocate this 40 Naira discount? Because what we are going to have eventually, what the company is going to collect eventually is 100 Naira. How are we going to allocate this money? What we are going to do is simple. The two of them together, they are 100. So let me put the formula. Let me just put the explanation here. So for product B, we are going to be saying product B equals product B. We are going to be saying what? 55 divided by 100, which is the addition of the two, then times the 40 Naira, which is the discount. So as to know how much to allocate to product B for discount. And for product C, product C, for product C equals, the formula for product C is, we are going to be saying what? His own is 45. 45 divided by 100 times 40. That's the formula. That's how to allocate the discount. That's the formula for allocation of the discount. Formula for allocation of discount. So we want to put the formula equals 55 divided by 100 times 40, which is the discount they have. 22 naira will go to product B, and here we say equals 45 divided by 100 times 40, which is how much? The 40 is the discount. The allocation to C is 18 naira. So, therefore, the discount that is given entirely is what? 40 naira. That's the discount that is given entirely. So, how much are we going to be having here? So, the formula here should have been minus, not sorry. We are removing discount from the price. How much are we supposed to be having here? So, if we drag the figure down, we'll be seeing that what we are going to be having. And what did I do? Standalone selling prices minus discount. That's what I did in that page just now. Standalone selling prices minus discount. And so we got the amount that the company eventually receives. And this is how they are going to arrive at their 100 naira, which eventually came to our account. Because the amount should have been 140. The discount they gave is 40. And then 100 naira is what they received. The consultation eventually received is 100 naira. The discount, therefore, is going to be allocated on this proportion. The proportion is 55 over 100. 100 is the addition of these two. So 55 divided by 100 times 40, which is the discount, we arrive at how much will go to B and how much will go in the proportion like that. This is how to calculate this trade discount for this transaction. This is how to calculate the trade discount for this transaction. You can see what we have done. Standalone selling prices, and this formula here explains how we allocated the discount. I want to believe nobody has a question in respect of that. Nobody has a question in respect of that. Fine. So we take another example. And if you have a question, please ask. The second example says, as Limited sells 3 products, the following standalone selling prices: product A, product B, product C. Products are normally sold at a discount. Normally sold at a discount, but X Limited agrees to sell one each of the products to Y PLC for 100 naira. Now, the products are to be delivered at 3 different points in time. So I'll be giving us another example that will be showing when they are to be delivered together, how the discount should be allocated. But this one we are doing is that they are delivered at 3 different points in time. So how are we going to allocate price? How are we going to allocate this price? What are we going to be doing? Let's do that example again. So the difference between the first example and the second example is because first example has specifically told us that it's only product B and C that are sold regularly at a discount. The two of them are sold together for 60 naira. And though the standalone selling prices here in the question is what? 100 naira. Sorry, it's 100 naira. You see? But the two of them should be sold together for 60. That's why we allocated the discount only to the two of them. So that the addition of these two will be 60 naira. That is how much the two of them are sold. And this is how to allocate discount. Because, and we treated it like this because they are delivered at 3 different points in time. So when A is delivered, 40 naira is recognized as revenue. At the point that we deliver B, 33 naira will be recognized as revenue. At the point that we deliver C, 27 naira will be recognized as revenue. So we want to do example 3 for this other one, that there is no specific explanation to us as to which product should bear the discount. So it's also allocation of discounts. That's the example. So we are going to be having the same headings we have here. Let me quickly take them there like that. And then the product ABC. Just try to copy so that we don't start putting those things together again. So for product A, the standalone selling price in this question for product A is what in this question? 50. So 50, 25, 75. 50, 25, 75. 50, 25, 75. So we now want to see how the discount should be treated. Now that we do not have a specific information as to which products are normally sold at discount, since all of them are normally sold at discount, please watch out in the question. They will point out signal for you to know. If they say, okay, product B is not sold, it's never sold at a discount, please, when you want to allocate discount, don't allocate to product B. If they tell you that product A cannot be sold for less than this amount, make sure that you pick that amount, that's the minimum amount that a product can be sold there. You allocate the discount, the difference between the standalone selling price and the price they gave you for that product. And then the remainder is what you allocate to the rest. But in this case, the allocation will go like this: product A equals, we are going to be having 50 divided by the total 150 times, what's the discount? This collected 100 naira, the amount is 150, so the discount is 50 naira times 50. That's going to be the formula. Okay, 50, right? I wrote 5 times 50. That's going to be the formula for A. For B, product B, we are going to be having 25 divided by 150 times 50. For product C, we are going to be having the what, 75 divided by 150 times 50. That's the formula we are going to be using to arrive at the discount for you. So let's do this one. Equals 50 divided by 150 times 50. So we have the discount for this one clearly stated here. So let me read like that. And then we do this one. Equals 25 divided by 150 times 50. We have that also there. And then here we have 75 divided by 150 times 50. So we have all the discount that is actually given here. It's how much? 50 naira. We have all the discount that we normally give here, which is 50 naira. So then, how much is the consideration that the company will eventually receive? Don't forget the transaction price, standalone selling price minus the discount we have given. That's how much they will receive. And we can drag that down for other one. So eventually, what the company will receive is 100 naira. And this is how we allocated the price. We treated this like this because what? There are 3 different performance obligations. So what if they now give us one performance obligation, that the 3 products are to be one performance obligation? It means we are recognizing their revenue together. So, for instance, let me treat this one. This is what? Okay, different performance obligations. Let me put the key there. Different performance. I hate all this pop-up. That's why I have to limit the screen. Different performance obligation. Different performance obligations. That's the example we treated there. So let me just put it there. I will now do the one for a single performance obligation. This one is also the same thing. Different performance obligation. Different performance obligation. So different performance obligation. That's the example. That's what this example also represents, different performance obligation. So let's just treat one example for single performance obligation. Okay, I will treat this single performance obligation. Single performance obligation. So let's assume that it's a single performance obligation. How do we treat it? Single performance obligation. Single performance obligation. So you just move all the things we have here, the headings, and then the products. Just copy and paste to save time. The products, sign, and then the information, the standalone selling price. So if it's a single performance obligation, all these things, there is no need for us to cross it like this. Sorry. So what I'll just do is product A, B, C will be treated as one. Product A, comma, B, comma, C. And so this will not be necessary. The total amount of product A, B, C is what we are going to be having in this place, which is how much? 140. And so the discount will be the entire discount of 40 naira. And then the difference will just be the the consideration that we eventually received, 100 naira. That is how to treat it. If it's a single performance, just pick them all together and remove the discount alone from the transaction. And then, because it's one time, you recognize the revenue. We treated it this way because we are recognizing the revenue at different points in time. They didn't happen together. They were delivered 3 different times. But here, we recognize it only once. The same thing will happen to this one. So I want you to do this one too on your own. Just try to allocate discounts once. And if B and C are to be delivered together here, if B and C are to be delivered together, the thing we are going to do is what? Just to allocate, we take the figure for the 2 of them, that is product B and C. Let me just do that one here. Product B and C. The amount for B and C is what? 100 naira. That is 25 plus 45. The amount of discount on B and C is 40 naira by nature. And so the total amount to be received is 60 naira if they are delivered together. But with the first example we did is when they are different performance obligations. But when they are single performance obligations, they will be treated like this. So the same thing you will do under this circumstance. So what we just learned is how to allocate discounts to these standalone selling prices to know how much we need to recognize. So finally, before we go, the last part of the standards is recognize revenue. Recognize revenue when or as an entity satisfies performance obligation. So revenue is recognized when or as the company satisfies performance obligation by transferring a promised goods or service to a customer. The amount of revenue recognized is the amount of the transaction price allocated to the performance obligation. So you can see transaction price, that is how much is there, except that we remove the discount. Goods and services are assets, and even only momentarily when they are received and used, as in the case of many services, an asset is transferred when or as the customer obtains control of the asset. Now, how do we recognize revenue? The journals for revenue recognition. I hope we know it. Okay, I'll just do it here, just for this, the 2. So revenue recognition. Let me just say revenue recognition here. Revenue recognition. Revenue recognition. For revenue recognition, the double entry is what I want to do, debit, credit. we are familiar with that, but let me just not say. So for this kind of transaction now, when everything is done together, you recognize the revenue together. So what we did is what? Debit receivable, receivable slash bank in case the money is paid. Debit receivable with how much? The amount of the revenue, and credit revenue. Revenue. That's how, that's credit revenue. Credit revenue, and that's how much? 100,000. You can see that's double entry for revenue. Then we can have an amount. So being the revenue from sales of product, being revenue from sales of product. That's it. So that's journal for revenue recognition. I hope we get it. This is when 3 goods have to be delivered together, and this is when only the 2 goods are to be delivered together. So that's about that. And so we have been able to lay the foundation now. So from next week, we'll now be looking at some other conditions under IFRS 15, how they should be treated, and we'll be treating issues that has to relate with construction contracts, how revenue is recognized when it is done over time, when it's done at a point in time. I hope you enjoyed the class. So please, I'm waiting for any comments. If you have anything to say, Juliet, I know you are still there. Okay, Mrs. Ogunleye is also still here. Some people have left. Okay. So please, you have anything to say, you have a question, please quickly use it. We have to leave now. If you have anything to say, please use the chat. Okay. Let me stop recording.